Hi everyone. So the Canadian federal budget just got released, and already there's been a lot of talks. I'll start to have conversations with clients, start to have conversation with potential clients. And so what I'm going to do is take a few minutes today and just kind of talk about that and how it affects everyday Canadians. And quite frankly, many people look at it and goes, well, based on what I'm seeing here from the numbers, it doesn't affect me, but you have to consider that potentially it will. So let's jump into this. Okay, so based on the budget that just came out, starting June 25th, 2024, this year, corporation trusts and individuals with capital gains exceeding 250,000 could be taxed at 66.7%, and that's an increase from the current rate of 50%. Now, it's important to notice that individuals with capital gains exceeding $250,000 will be taxed at 66.7%. But for corporations and trusts, starting June 25th, for every dollar of capital gains, you're going to be taxed at that new rate, right? So I know there have been some confusion around that. So in the big scheme of things, this is quite significant. No, some people might look at this and goes, well, I'm a regular T4 person. I work, I get my paycheck, $250,000. Well, that probably will not affect me. And it may or may not. We'll dive into that a little bit more. Now, if you've been saving and you have non-reg, that's non-registered accounts, non-sheltered accounts, that exceeds $250,000, then potentially you could get hit with a spill, and you might say, well, when am I ever going to take out that amount? And it's quite unlikely, depending on your circumstances. But if you're forced to sell for any reason, you will get hit with this amount, right? That's something to consider. Now, you may say, well, you know, probably doesn't affect me. Here's another thing you have to consider, that if you're selling investment properties, and as I mentioned, large portions of your retirement portfolios, that's a potential there to push you over that 250,000 threshold. So if you have real estate, there's a potential situation there where it will be affected. But here's where a lot of people may get caught in this. At debt, all Canadian investments are considered sold. It's considered a disposition. In fact, it's considered a disposition just before debt. And if you have an asset that has a built-in capital gain, at that point, it's considered a disposition. So it's as if you sold that property. Now, if you're married, you could, it will pass on, the assets will pass to your spouse. And so you will only get taxed on the death of the last spouse if you so elect. And so you have some potential room there. But on the death of the last spouse, it's considered a disposition. And if it's a disposition, at that point, you may exceed the threshold. So you may have a large portfolio, and over time, you have not exceeded this amount. But on death of the last spouse, if your portfolio is over the $250,000, you will get caught by this. If you are someone who invests in real estate, especially if you're in the GTA area or certain areas of Vancouver or different parts of Canada, where you have a portfolio that exceeds this threshold, then you will also get caught in that. Now, let's spend a little bit of time on corporations. And this is where I think, you know, just the everyday working individual who may not be significantly wealthy is going to get caught by this. There's an increase in capital gains tax for people who have corporations for every dollar. And so what this may do is push individuals who normally, or maybe you're considering investing in a corporation to say, you know what, I'll probably do that as an individual. And at that point, in a lot of circumstances, what you may be faced with is more exposure in terms of risk, because one of the reasons why people invest in corporation is to have that protection, that asset protection that you have that comes with being a corporation. But they may have to weigh that with the fact that you have potential higher taxes, right? Now, there is some, a bit of a help from the government here in that the lifetime capital gains exemption, which was a million before, roughly a million, has now increased to 1.25 million. So if you're planning on selling your business, you essentially will not have to pay taxes on the first 1.25 million in capital gains. So there is a bit of a help there, but nonetheless, on a day-to-day basis, the increase in capital gains as a corporation or trust is something that could, have significant impact. So what are some of the solutions? And again, this is all new. We will wait to see if this really stays or not. And we're still all new at this. We're trying to figure this out. But here's some solutions that we have, right? You could gradually sell assets over several years to keep annual capital gains below $250,000. So if you know that you're going to exceed that threshold, And if you can, you could be strategic in how you sell off those assets over the years, right? So you don't just do it all at once, you spread it out. Um, you could also use life insurance if you have a huge potential tax liability on death. You could have life insurance. In some cases, it's more cost effective than paying out those taxes directly. Charitable donations are not an alternative. Debt, instead of giving money to CRA, some people will say, well, I'd rather opt to give that to charity. So there may be opportunities for charitable donations here to offset those tax bills. One question one question that may come up is, okay, should I sell before June 25th? Be very careful about that. In fact, I strongly recommend you speak with your financial planner, advisor, accountant, whoever you are working with. If that is going to be your route, just think it over before just be impulsive and just sell your assets in order not to have this tax bill. Because if you do that, you're going to have potentially significant tax bill, which may or may not work out in your best interest. So I strongly recommend that you take the time to do this. Another solution, quite frankly, that's not listed here is getting a financial plan. Look at your overall assets and see what's the most tax efficient way to do that. Now, you may be working with a planner before, great. Then what you want to do is revisit this plan, especially if you know that you have investment property, if you have corporations, and if you have significant amount of assets in non-reg. See if there's things that you could do to be strategic and to be tax efficient, right? So hopefully this was helpful. Again, Art of Retirement. I have a book called Art of Retirement, and there's a whole section there on tax minimization. So there are opportunities here, a lot, not a lot, but there's a part that does talk about saving on capital gains. And hopefully this has brought you some information that will be helpful. Again, this is all very new, and this is proposed at this point. Let's see if it sticks or not. But as I had said in a previous interview before, sometime last year, that it's inevitable that there's going to be an increase in tax. And I even proposed that potentially they're going to increase capital gains tax, and here we are. So again, I strongly recommend that you meet with your advisor or your planner just to make sure that you're doing the right thing. Hopefully this was helpful. If you need to reach out to me, my contact is in the section below. Reach out. Talk to you soon. Take care. See you next week.